$2 billion moves through Dubai's banking system every single day, a figure that has defined the city as the world's ultimate financial sanctuary over the last decade. On the surface, the momentum feels unstoppable. The cranes are still moving, the gold is still flowing, and the private jets are still landing at Al Maktoum International. But look closer at the ledgers by early 2026. While the headline numbers remain massive, certain liquidity indicators suggest a quiet, calculated deceleration is beginning to take root. For the first time in years, the speed of capital entry is no longer accelerating. It is stabilizing. A city built entirely on the physics of constant expansion, stabilization often feels like a warning. The skyscraper lights are still on, but the behavior of the money behind them is changing. Something is shifting beneath the desert floor. To understand why this shift matters, we have to look at the sheer scale of the dream built over the past 18 months. Dubai didn't just recover, it recalibrated. By the end of 2024, Dubai's GDP had surged by nearly 4.5%, driven by a relentless influx of high-net-worth individuals and a digital economy that grew faster than almost any other hub in the Middle East. The city welcomed over 100,000 new residents in a single year, pushing the population toward the 3.7 million mark and creating a demand for luxury that defied global inflation trends. At the peak of this cycle, premium real estate prices in areas like Palm Jumeirah saw annual increases of over 25%, while the banking sector reported record-breaking profits fueled by massive capital inflows from Europe and Asia. It was the perfect narrative of an invincible tax haven. The data suggested a perpetual motion machine, a desert miracle where $1 million apartments were being flipped for double their value in record time. For a moment, the world believed that Dubai had finally disconnected itself from the gravity of global economic cycles. The skyline remains as sharp as ever, and the world's tallest buildings still glow with a quiet confidence. But beneath the surface, the first microscopic cracks began to show in the final months of 2025. While residential transaction volumes hit record highs, the secondary market, the heartbeat of actual investor liquidity, began to see a behavioral shift that data is only now starting to catch. In certain luxury segments, the time it takes to flip a property has stretched from weeks to months, and by early 2026, rental yield growth in Dubai's core districts finally slowed to just 1.3%, a sharp contrast to the double-digit surges of previous years. For the first time since the post-pandemic boom, the urgency has vanished. High-end buyers are no longer rushing to sign contracts in 48 hours. They are pausing. They are asking questions. This subtle hesitation in the capital cycle suggests that the era of easy expansion is being replaced by a much more cautious, data-heavy reality. The dream isn't over, but it is certainly getting more expensive to maintain. The numbers provide a clarity that the marketing brochures tend to omit. By the second quarter of 2026, the total value of capital inflows into the UAE's commercial banking sector reached a massive $180 billion. But the composition of that money is shifting from long-term investment to short-term parking. While the supply of new residential units is scheduled to hit a staggering 45,000 deliveries this year, real estate absorption rates in the mid-market tier have dipped by nearly 12% compared to the 2024 peak. This creates a supply-demand mismatch that is impossible to ignore. The cost of corporate financing has remained stubbornly high, with some local lending rates hovering around 6.5%, putting immense pressure on mid-sized developers who leveraged heavily during the 2023 land grab. We are also seeing a price trend divergence. While ultra-luxury villas still command premiums, the broader residential price index has seen its growth trajectory flatten to less than 4% annually. The data indicates that the premium being paid for the Dubai brand is reaching its ceiling. When the cost of holding an asset rises, while the pace of appreciation slows, the math for institutional capital begins to change. It isn't coming from a lack of money, but from a calculated decision by the biggest players to wait for the floor to set. This economic friction isn't just happening on spreadsheets. It's being felt on the ground by the people who keep the city's heart beating. Over the past 18 months, the cost of living has undergone an aggressive recalibration, with average annual rents in family-centric neighborhoods like Dubai Hills and Al Barsha climbing by another 18% in some clusters. For a professional expat family, the math is becoming increasingly difficult to justify. School fees, which already represent one of the highest household expenditures in the region, saw government-approved increases of up to 5% for the 2025 to 2026 academic cycle. When you combine these rising costs with a 10% jump in basic utility and service fees, the tax-free advantage begins to erode under the weight of invisible inflation. Analysts are noticing a distinct behavioral change. The mid-level executive class, once the backbone of Dubai's long-term residency, is starting to look at secondary markets or even considering a return home. It's no longer just about how much you can earn in Dubai, it's about how much the city requires you to spend to stay in the game. This quiet accumulation of pressure is driven by three distinct structural shifts. First, the global interest rate environment has fundamentally altered the math of the desert. For the past 18 months, as global rates remained higher for longer, the opportunity cost of parking capital in Dubai's zero-interest accounts grew too large to ignore, causing a significant portion of passive wealth to migrate back towards sovereign bonds. Second, a massive supply wave is hitting the market. With over 40,000 units slated for completion by the end of 2026, the scarcity that once drove the 20% annual price hikes has evaporated. Third, the regional competition factor is no longer a theory. Reports indicate that neighboring hubs are aggressively slashing corporate entry costs to lure away the very startups and family offices that Dubai spent a decade attracting. Each of these causes acts as a silent drain on the system's momentum. While no single factor is a killing blow, combined, they represent a fundamental cooling of the engine. The system isn't failing, but it is being forced to find a new equilibrium in a world where being the only game in town is no longer a reality. This creates a polarizing landscape where two distinct realities exist simultaneously. On one side, the institutional optimists argue that Dubai's infrastructure and $100 billion plus sovereign wealth backing make it more resilient than any Western capital. They point to the 2025 influx of logistics and AI firms as proof that the city is successfully pivoting away from pure real estate speculation. However, on the other side, risk analysts are raising flags about the liquidity lag. They suggest that while the skyscrapers are built, the debt used to finance them was structured for a low-interest era that no longer exists in 2026. The tension is palpable. The city is either on the verge of its most sophisticated evolution yet, or it is entering a period of prolonged stagnation. This duality makes every $100 million deal feel like both a victory and a gamble. Capital is currently split, with half the market doubling down on Dubai 2.0 and the other half quietly moving their exit strategies forward. We have an expected initial agenda, but this requires absorbing the 15% to 20% increase in operational overhead and the risk of a softening secondary market. Option B is to exit now, locking in the massive gains of the last 3 years, but this means potentially missing the next evolutionary leap and facing the difficulty of finding another jurisdiction with comparable safety and infrastructure. By early 2026, data suggests a wait-and-see approach has taken over, with cash-on-cash transactions slowing as participants realize there is no longer a clear, risk-free answer. The psychological tension is rising because, in Dubai, standing still is often perceived as falling behind. Both paths lead to a landscape defined by uncertainty, and for the first time in a decade, the smart money isn't moving in unison. It's hesitant. What is happening in Dubai is a localized symptom of a much larger global reconfiguration. We are witnessing a fundamental shift in how the world's elite move and protect their wealth in an era of high interest rates and geopolitical volatility. By the middle of 2026, capital is no longer just seeking growth, it is seeking a fortress. This evolution of luxury means that a city can no longer survive on glamour alone. It must provide a deep structural utility that justifies its rising costs. As global capital strategies pivot toward quality over quantity, the traditional models of rapid real estate speculation are being replaced by a more disciplined, institutional approach. Reports from the first half of 2026 indicate that wealth behavior is becoming increasingly mobile and less loyal to any single geography. If the world's most liquid capital begins to treat Dubai as a transient platform rather than a permanent home, it signals a new chapter in the history of global finance, where the competition for the 1% is no longer about who can build the tallest, but who can remain the most stable. The $2 billion flowing through Dubai's banks every day remains the ultimate symbol of the city's ambition, but the math behind that movement is changing. As we move through 2026, the question is no longer about whether Dubai can grow, but whether it can sustain the cost of its own success. The signals are there for those willing to look past the neon, the slowing transactions, the rising cost of entry, and the quiet hesitation of institutional capital. Is this the natural cooling of a mature market, or the first sign of a deeper structural vulnerability? If the desert's most successful experiment is reaching its limit, where does the world's most mobile wealth go next? Share your perspective in the comments. Are we witnessing a pivot or a peak? This is part 1 of our series on the new global capital shifts. Subscribe to see where the money moves next.